This information was obtained from reliable sources. However, Lantern cannot guarantee its accuracy. Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for presentation purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in security does involve risk and the potential of losing money. This material does not constitute research, investment advice, or trade recommendations. Lantern does not provide tax, accounting, or legal advice.
And now introducing Mr. Keith Lanton.
Good morning. Hope everyone had a nice summer weekend. So we're going to get started this morning. Going to talk about something perhaps we can observe in politicians, both here in the United States as well as overseas, and more importantly, going to talk about some things that people do when they are uncomfortable, and things that you can observe when speaking with others, whether they are clients, loved ones, prospects, business colleagues, some behaviors. We talked about this. Some things that people do in different circumstances, and going to elaborate on that, and hopefully be able to provide you with some information that you can utilize as a tool going forward to help as you speak with others, and do your job both as an advisor as well as your job as a parent or a spouse or whatever the relationship may be. So I'm going to start out talking this morning that there is a component of our brain that has evolved due to evolutionary forces. This is what some scientists call the limbic brain. The limbic brain is the sort of automatic response that our brain will have when it's approached with certain stimuli. So, for example, to give you an idea of what the limbic brain is like in its most extreme settings, something to the effect of when you reach out, touch a hot stove, perhaps you're a young child, touch a hot stove, and you get burned. And going forward, when you approach a hot stove or something that reminds you of that hot stove, your very quick, immediate, knee-jerk reaction or reflex is to pull away from that stove. You don't think to yourself, oh, that's hot, let me pull away. It's as you approach something hot, you instantly pull back, virtually beyond your control. Another example is if something or someone, let's call it an animal, perhaps a friendly animal that we typically associate something with, like a dog, bites a young child. It is very common that when a child sees a dog for quite some time, that their immediate reaction will be to pull back, grab their parent's leg. Immediate response. These are survival responses that we have evolved. Now we can utilize those reactions that take place more subtly when we are interacting with others, and these are other limbic responses. So one thing that people sometimes do is they do what are called blocking behaviors. And this is behaviors when you want to block something that's taking place from affecting you. So some reactions that people may have when they are in a situation that is uncomfortable to them, they will do things like closing or rubbing their eyes, which is to block what's taking place in front of them. It's a subconscious limbic response. They will sometimes place their hands in front of their face. More of an extreme reaction. More subtle reaction that you will see people do when they are in an uncomfortable situation is they will lean away from whomever it is that they are interacting with. It could even be a subtle push back, but the torso moving away from what they view as a situation that they are uncomfortable with. Another thing that is very common and very subtle is a shifting or turning of the feet towards the exit. Could be someone just sitting in a chair in a conference room talking to a client, and you notice the client perhaps just very gently moving their feet in a direction of the exit. All of this is a limbic response, somebody who wants to block or create distance between themselves and something that's uncomfortable. The next stage of that blocking behavior that people will then typically engage in are what are called pacifying behaviors. And pacifying behaviors are the body seeking to restore itself to a normal condition. And the brain is enlisting the body to provide comforting behaviors. And some of these behaviors that you will see people engaging in, and to some extent males and females will both engage in pacifying behaviors, but they'll do it in a slightly different way. Men frequently will touch their neck, or what they'll do is they'll take their shirt collar and they'll sort of fan it or move it away from their neck. This is a common reaction to try and pacify. There's lots of nerves in the neck that soothe. Women more typically, when they're doing some sort of behavior that's stressful to them and they want to pacify themselves, will frequently adjust the necklace that's around their neck. And also women very frequently, especially when it's even a more uncomfortable situation, will cover or touch what's called the suprasternal notch, which is the hollow area between the Adam's apple and the breastbone. They will make some contact with that area when they are in an uncomfortable situation. People who are smokers will typically smoke more in order to pacify themselves. You'll see them get more aggressive with their smoking. Other behaviors that you will observe is something like exhaling with puffed out cheeks when somebody is in a stressful situation. They're trying to calm themselves down. People often frequently touch their faces. There are lots of nerve endings in the face, so they'll touch their face. They may rub their forehead in order to self-pacify. And one final thing that you'll observe is someone, and this is something that investigators frequently look for, is somebody who cleans the palms of their hands on their laps. This is something that people do reflexively. They don't even think about it, and is a quick response to something negative. They'll take their hands, put them on their thighs, and sort of stroke them forward towards their knees. Is a pacifying behavior. So some things that you can observe. I'm sure you'll see it even today. Perhaps it'll help in terms of better interactions with others. All right, we're going to get started this morning. Talk about what's going on. A lot going on. Unfortunately, we had 2 tragic shootings over the weekend, and that certainly is something that psychologically affects everyone in this country, and that's something that's also going to be somewhat controversial here as the Democrats and Republicans once again start talking about gun control, which is controversial, and we'll see if these 2 tragedies are able to have any influence on public policy. We also this morning have China's response, and this is weighing very heavily on futures. China's response to President Trump's decision to impose 10% tariffs on the remaining $300 billion in Chinese goods on September 1st. And also an article with respect to that came out over the weekend in the New York Times that many of President Trump's advisors were not in favor of imposing those tariffs. So that's also creating some thought on how unified the administration is in terms of these policies. But the Chinese this morning taking some actions that some view as deciding that they feel that their response at this point is one of sort of capitulation, in the sense that they do not feel that there is a path forward. And the reaction to those responses is being seen in the markets this morning. So the Chinese doing 2 things overnight. One, saying that they've instructed their state-run governments not to purchase U.S. agricultural products, and perhaps more importantly, the Chinese over the weekend letting the currency, the yuan, fall below the psychologically important 7 level. something that the Chinese have not allowed to happen since 2008, and saying that is in response to the increased tariffs and that there'll be less demand for Chinese currency, and therefore this is something that could inflame the president this morning. I think President Trump this morning made some comments about the Chinese manipulating their currency, something he has been hesitant to do. So the rhetoric ratcheting up this morning, and this is causing some concerns, or a lot of concerns in the financial markets. We're seeing Dow futures down about 350, S&P futures down 43, NASDAQ futures down 155. We are seeing a strong flight to safety in the bond market. 2-year Treasury down 10 basis points to 163. The 10-year is at a 178. The 30-year at a 232. So 6 to 10 basis points lower yields from already super low yields here in the United States. We're not seeing any escape from the selling, whether it's in Europe or Asia. European averages across the board down 1.5 to 2.25%. The biggest loser, the FTSE, down over 2% in London. In Asia, we are seeing the Hang Seng in Hong Kong down about 3%. That's on top of tensions that are radiating in Hong Kong. Further protests taking place, and the government expressing frustration with those protests, so that's only weighing further on sentiment in Hong Kong. The Shanghai in China itself down 1.6%, the Nikkei down 1.75%. We're seeing oil down about 1.25% this morning. West Texas Intermediate down to about $55 a barrel. Gold is up $17 as the rush to a safe haven. Gold, Bitcoin, both up this morning. Gold up $17 an ounce to $14.75. There was one commentator this morning, one of the analysts, perhaps at Bank of America, I'm not sure about that, speculating that another move that the Chinese may make if things deteriorate further is they could agree to purchase oil from Iran, which would obviously have not just economic effects but geopolitical effects. With the Trump administration remaining ardent that should not take place. And Bank of America, I believe is who it was, speculating that could cause oil prices to drop precipitously if that were to happen. So just something else to think about. Other news this morning, HSBC said the CEO there, John Flint, is going to be stepping down after just 18 months in his role at HSBC as CEO. That was a very surprising development, and markets not reacting favorable to that resignation. Also over the weekend, Berkshire Hathaway had earnings that its quarterly profit fell more than analysts expected, as weakness in insurance underwriting, a slowing economy, and trade woes weighed on the conglomerate run by Warren Buffett. Moving on to a couple of events that are going to be taking place this week. After last week when we had a slew of data, much quieter week, we do have some earnings. Today we get the Institute of Supply Management releasing its non-manufacturing index for July. It's expected to come in at 55.5. Tomorrow we get the Federal Reserve Bank of Australia announcing its monetary policy decision. Market expects the central bank to keep its short-term interest rate unchanged at 1%. And then on Friday, we have July producer prices expected to come out, and the forecast is for a 1.6% year-over-year rise. Core PPI expected to hit 2.3%, which is unchanged from June. Moving on to Barron's. Barron's ran a few articles that were suggestive of being cautious given all the uncertainty that's taking place currently and played out especially last week. So Barron's, in light of those events, getting more cautious, and this morning we're seeing some signs that perhaps, at least at the moment, that strategy may be prudent. Barron's saying just when it was safe to go back in the water, meaning markets were reacting from the the uncertainty around the Fed decision. Then there was another what they're calling Great White Attack, and that was the increase of rhetoric between the U.S. and China. So just to recap a little bit, give us set the stage for where we are today. On Thursday, President Trump announced he will impose a 10% levy on an additional 300 billion Chinese goods. That sent markets lower. Last week, the Nasdaq was down 3.9%. The S&P was down 3.1%. The Dow was down 2.6%. That resulted in a paper loss of about $1.1 trillion in equity assets. The tariffs' potential blow to an already slowing world trade had an even stronger impact on the bond market. The 10-year Treasury note last week, and it's even lower this morning as we discussed, fell 21.7 basis points. And that is the biggest one-week decline in more than 7 years, and that was from an already low level. The irony was that the bond market reacted more forcefully to the Trump tariffs than to the Federal Reserve's expected 25 basis point reduction in rates. The further corrosive effect of the new tariffs led the Federal Reserve Funds futures market to price in a 99% probability of another 25 basis point cut at the next meeting on September 17th and 18th. And a further cut of 1.5% to 1.75% is now up to a 75% chance, and that's before this morning. I believe, just reading as I'm talking to you, that when President Trump made some comments this morning regarding the Chinese currency weakness, that he said, "Did you hear that, Federal Reserve?" So calling on the Fed once again to lower rates and tying it directly this morning to the events taking place between the U.S. and China. Bank of America saying there's a limit to how much lower interest rates can offset the impact of escalating tariffs. Notwithstanding President Trump's claim that China pays the tariffs, Barron's saying they are levied on U.S. businesses and consumers. And once the additional $30 billion in tariffs is added on to the current tariffs being paid here in the United States, that $30 billion is 10% of the $300 billion. That would bring the total cost of tariffs to $138 billion this year, and that compares with $122 billion of benefits from the tax cuts. So it's possible that the benefits of the tax cuts would be more than completely offset by the effect of the raising of those tariffs. Trade data came out on Friday, and just to give you a snapshot of what's taken place as a result of the tariffs, imports from China were down 12.6% in June from a year earlier, while exports to China were down 16.8%. Now, meanwhile, imports from South Korea, Taiwan, and Vietnam were up 9.2%, suggesting that some substitution is already underway. But imports from those countries only amount to about 31% of those from China, because it's difficult for many companies to source quickly from new locations. Obviously, lots of work in order to change trading patterns. The trade situation last week largely overshadowed Friday, when we had the employment report, which showed an increase of 164,000 jobs. Largely came in as expected, but that did not get a lot of attention. Barron's suggested that the case for going into cash now may make a lot of sense, especially with these very low long-term interest rates, and short-term interest rates, as you know, are higher even after the recent cut in the Fed funds rate. We're now looking at Fed funds being somewhere between 2 and 2.25%. But those short-term rates look very attractive when compared with the 10-year Treasury here in the United States, which is at a 1.78. The 5-year is a 1.58, and those rates even look more attractive, those short-term cash rates, when you look at the 10-year German Bund, minus 40 basis points, the 100-year Australian bond, 100-year bond at 1%, 10-year Italian bonds at 1.6%, 10-year UK gilts at 60 basis points. So time will tell whether or not these rates could even go lower, or if these negative rates are something we'll look back on and view them with some level of insanity, very hard to judge. So if we're looking at historic trading and presidential elections, where we are right now, we are now approaching the period of time in the year before a presidential election when markets have performed the worst, and this goes back about 60 years. So between July and October, that is the span that has marked the worst 4 months of a year preceding a presidential election. The Dow in those years has tended to peak in July and then drop significantly in October. And typically the selling ends by Halloween, and then you typically see a rally going into the new year. We'll see if things play out somewhat similar this time around. Talking about barons and trading, they ran an article. China is no longer America's largest trading partner. The tariffs will keep it that way. In the wake of the recent developments between the U.S. and China, China has fallen to third in terms of trading partners with the United States. First is Mexico, Canada is second, and China for the first time since 2015 no longer first but third. Trade between the U.S. and China, the amount we've imported from China fell from about $200 billion a year ago to $180 billion this year. But despite that, our trade gap has still widened by 2.9% with the entire world, and this is because of increased trade deficits with Mexico, Korea, South Korea, and Taiwan. Moving on to a couple of other articles and barons, a couple of interesting stories. One headline story: retail reckoning has only just begun. This has to do with retail stores here in the United States. And Barron's saying that the pace of store closings, which is going at a feverish pace, will only continue and get stronger. This is despite the fact that U.S. retail sales have been growing. They've grown 3.5% this year after rising 4.3% last year. U.S. retailers have already announced 7,500 store closings this year. If you subtract openings, that leaves a net closing of 4,500 stores this year. Last year, a net closing number of 2,606 in all of last year. Barron's suggesting is that if a company is not exhibiting positive trends or is trying to turn things around, now is not the time for patience with companies showing poor results. They point out that currently we are in sunny times. Stores should be doing well, and they are concerned that companies that are struggling could collapse during the next rain or the next time things get less friendly here in the U.S. For retail sales. Now we know the primary reason or the part of the reason for the shakeout is Amazon, which now accounts for 6% of U.S. retail, as well as the fact that Walmart and Target are doing a much better job of reaching broad customers, both in stores and online, and this is having a significant impact on other retailers. Barron's also suggesting that part of the problem is that we were probably overstored to begin with before all of the competition from the Internet became severe and intense. The suburbs, they say, are overstored and undershopped. About 20% of U.S. malls are thriving, which means that 80% of U.S. malls are suffering. There are about 1,350 enclosed malls in the United States, but analysts estimate that somewhere between 200 and 400 are needed. Interesting statistic is that the United States had 23 square feet of retail space per person last year. That compares with countries like the United Kingdom, which had 5 square feet. Spain had 4 square feet. Germany 2. The United States 23. Analysts estimate that it could take up to 10 years to get the U.S. store and store count in balance with demand. And this is something that sounds like it could be a phenomenon that goes on for several more years. On the positive side, Barron's wrote an article very positive on HP Inc. That used to be called Hewlett-Packard Incorporated, now called HP Inc. Hewlett-Packard has recently spun themselves off in the last few years, in actually 2015, into two companies. One is called Hewlett-Packard Enterprises, and one is called HP Inc. Hewlett-Packard Enterprises makes servers, storage arrays, and things that consumers will possibly never see, whereas HP Inc. makes computers and printers for consumers and businesses. So Barron speaking positively here on HP Inc., symbol HPQ, Hotel Paul Quality. They point out that HP Inc. Is expected to have net income this year of $3.4 billion, a revenue of about $59 billion, and they expect earnings of about $2.18 a share. This is for a company trading at approximately $20 per share. HP dominates the U.S. here for both PCs and laptops, which accounts for 64% of their business. They have about a 30% share of laptop and PC business. The rest of their business comes from printers, and that 36% of business does account for 70% of profits in the latest quarter. HP is trading at 9 times earnings. It's the sixth cheapest name in the S&P 500 infotech sector. The stock yields 3.2%, and the company continues to buy back stock since the beginning of last year, 2 years ago, since the beginning of 2018. HP repurchased more than 10% of its outstanding stock. Where do analysts see potential for opportunities? It's predominantly in the printing space. HP is getting much more aggressive with a sector of the printing space called the A3 printers. These are printers and copiers that have become central resources in large offices. It's about a $25 billion a year market, and these are the industrial printers that you see in offices that the majority of the office prints to. HP also getting more aggressive in commercial graphics, which are specialized printers for signs, packages, publications, and textiles. And HP is also getting into printing as a service. How does that work? HP recently rolled out HP Instant Ink, which allows customers to pay by the page. You can pay $3 a month for 50 pages. You can pay $20 for 700 pages, and there are different packages as the volumes change. Consumers, they say, like it because they don't have to guesstimate how much ink costs. They just need to know how many pages they're printing. And sort of the call option on HP is 3D printing, something that was all the rage that really HP was not participating in. But HP is working on cutting-edge hardware that can print parts or entire products from scratch. They're expanding from plastic to metals. They have alliances with Siemens, Jaguar, BASF, General Electric, and the list goes on to significant Fortune 500 companies. As has been observed in some of the other stocks in this space, the 3D opportunity has taken longer to come together than originally hoped. But now some analysts are speculating that in the next 3 to 5 years that this technology may catch up with the business, and that the competitors have been weakened, and HP may turn out to be the company that is on top. So this is something I think is an interesting article. Some ideas who are seeking advice about creating income in retirement and how they can afford to retire. And recently there was an academic study around longevity, and a professional body dedicated to managing the risks of aging came up with a solution to what Nobel laureate William Sharpe has called the nastiest, hardest problem in finance: turning retirement savings into a predictable stream of income over a period of span that could last decades. I'm seeking to achieve. The Nobel laureate, Mr. Sharpe, said it's hard to strike a balance because there are so many variables, such as years in retirement, inflation, market performance, and so little room for error. This agency called the Stanford Center on Longevity came up with what they call the Spend Safely in Retirement strategy, and it entails 2 components. Number 1 is wait to claim for Social Security. To maximize your Social Security benefits by claiming benefits as late as possible, ideally age 70, when recipients receive 132% of their full monthly benefit, and they get that in return for delaying 48 months. They conclude that Social Security is probably the best retirement income source for most middle-income people because it addresses every common financial risk. Number one, it's indexed for inflation. Number two, it protects against longevity risk because it keeps paying. And number three, if the stock market crashes, it doesn't go down. It also protects against what they call cognitive risk, which is recipients needing to worry about making complicated investment decisions, or in some cases turning over their assets to someone to make sure that they can maximize that income in retirement, and there is room there for error. How do you delay taking Social Security until age 70? If you don't have the financial means, then the second best choice is to keep working. The article goes on to then say, what's step two? The second step is something that is not as intuitive, and that's to invest retirement assets more aggressively than had traditionally been prescribed by experts, while, of course, withdrawing as little as possible. The thinking here is that retirees who adopt the first part of the strategy to rely more heavily on Social Security income, that's a higher income, can afford to take more market risk because they get that higher Social Security income. Some in the Stanford study even suggest that an allocation as high as 100% to stocks might be acceptable for some retirees. That, of course, is not appropriate for every retiree. As part of the strategy, how much do you withdraw if you're investing that other portion of your assets? The recommendation is to withdraw no more than the RMD, or required minimum distribution table, would indicate that you should pull out. Clearly, with interest rates lower, need to get more creative on helping people survive in retirement, especially when they're living longer. Interesting study there out of Stanford, and something that may be appropriate in certain situations. That's everything I got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.